Good evening, everyone, and welcome to another exciting episode of IQI Canada Evening Talk. Yes, it's that time of the month again. It's the last Monday of every month, and when we have our chief economist Shan Saeed who will come us and give us a global economic outlook about what's happening around the world. And for me, every session is exciting, but this is a special exciting session because I always look forward talking to Shan on that. So first of all, good morning, Shan. Welcome to the show. How are you doing?
Good morning, Yousaf. I am absolutely perfect. Thank you for having me again.
It's all our pleasure on that. You know what, Shan? I would before I get into my question and answers, one thing I'd like to know from you, which is out of my question on that. Shan Saeed, Chief Economist for Juwai IQI, and with Juwai IQI, our offices being in 21 countries with over 20,000 agents. And as a Chief Economist, you're not just looking at one country, but you're actually looking at the full global economic outlook. You're looking at different countries, different policies, and that's how you give us the advice, and that's how we are able to advise to our clients as well. Shan, how do you do all this?
Yousaf, it all boils down to one word, and that is your networking, your global networking. So I'm not in the habit of spending a lot of money. I believe that your networking from various regions, they can help you a lot. So we have presence in 21 countries, how to cover while sitting in Kuala Lumpur. So I make the best use of my networking. And I always believe in one thing, that you sit with those people who are smarter than you. So when I was growing up, I was in school. So there was a proverb: a person is known by the company he keeps. So you are
Absolutely.
known by your company. So I have friends who are smarter than me and who have gone to top schools. We have played hockey together. I know them from my school days, almost 33, 34 years back. And you get to know people through substance.
Yeah.
And in the last 10 to 12 years, I have got to know a lot of people from US, from Europe, because of my networking at University of Chicago. People in Chicago have introduced me to other networking as well. Plus, I've attended so many networking events, so I keep in touch with those people whom I feel that they have got substance. Nowadays investors are looking for substance. They're not looking
That's
for
right.
any tabloid stories. So
That's
hard
right.
facts, market driven data, and substance, these are three things that are important for those sophisticated and smart investors who are following Juwai IQI. So to answer your question, it boils down to one thing: your global networking.
Absolutely, you rightly said, and I know that, Sean, you are all over the global networking because I see you in so many newspapers, and different timings. It's like you're also working like a 24/7 sort of clock. All of a sudden, I'll see a post coming up at 3 o'clock in the morning your time, 4 o'clock morning in your time as well on that. So, Sean, let's get to our questions today. What I'll do today is that, Sean, I like to share my few of the graphs, ask you a question, and then you can answer about that question as well. So of course, what's going on with the oil market. So Shan, it's oil news all over the top newspapers. Oil is up by 71% year to date, and you're in the limelight in the press and media for your cause. Man, oil is getting very volatile. Oil market is on fire and really continues to hold grounds. Like, please tell us what's happening, at the year end and the outlook for 2022. What is the main premise of high oil prices? Do you think we are heading to a 2008 scenario when oil prices were trading around what 147 to 148 per barrel?
Yes, Yusuf, oil is everywhere. As you rightly pointed out, that all the major newspapers, press, and media, they are covering oil and gas. And as you know, oil is, as you rightly said, oil is on fire, and oil is on the upsurge. Year to date, oil has gone up by 71%. Nobody thought it would go so high. At the start of the year, we said 50 and $70 per barrel. By 8th March this year, oil was already hitting $70 per barrel. So by first week of July, we had to revise our figures. And for second quarter, for second half of this year, that is H2, from July to December, we have already made a forecast of 73 and $87 per barrel. And right now, when I speak to you, oil Brent is trading at $85.60. So it is just $1.40 to go before we hit our second target for the year. So we have been quite spot on in terms of our outlook in the energy market, and that has really given us a lot of limelight in press and media. Tomorrow, I'm taking another interview with Star newspaper. Last week, I was with New State Times. So the newspapers, the journalists, these folks are looking for substance, and they normally ask me the same question that you asked me at the start. Shan, how do you get this data? So I just tell them I have networking from the global landscape, and I use my networking for my advantage. So oil is on fire. The reason is very simple. The economies are opening up, the demand is going up for energy. So that's why there is shortage of supply. We have not seen enough capex investment, that is capital expenditure,
Yeah.
especially from oil and gas companies. So that's why oil is on the upsurge. Plus, there is a phrase called backwardation in the energy market. What is backwardation? When your spot price is higher than your future price. Your
Mm-hmm.
present price, when I speak to you, is higher than your future price. That is tomorrow. And most of the people, they would sign contracts as of today because the investors are not sure, the economies are not sure, those who are importing, that whether we will get enough oil supplies tomorrow or not. And as you read yesterday's report from Morgan Stanley, the demand for LNG is the future of energy, will go up by 25 to 30% in the next 5 to 10 years. So if you just look at the overall scenario in the energy market, coal is back, coal is up, natural gas is up by almost 137%. Brent is up 71% year to date. So all these commodities are back. And for next year, I've already shared in NST New Straight Times last week, and I'm sharing the same with Star newspaper tomorrow, that oil prices will meander around 77 to $107 per barrel, with the premise that prices will go up and we might see a repeat of 2008. I'm glad you brought
Wow.
this up of 2008 because I still remember I was having lunch 11 July 2008. I was in Chicago sitting with my Nobel laureate professor, and oil prices hit $147
Wow.
and I think 17 or 23 cents. I don't remember the cents, but I do remember
Yeah.
the exact figure. And I was talking to my professor and said, Professor, I think prices will go down. But one of the analysts from an American bank, he said $200 per barrel. So professor said, why don't you go? So I posted my comments on CNN
Mm-hmm.
at that time that I don't see the oil prices heading to $200 per barrel. They might be hitting at $97 per barrel. 31st December 2008 is available on the internet. Oil prices touched $34 per barrel. So
Wow.
from 147 on 11 July, they came down to $34 per barrel. 31st
Wow.
December 2009, oil was trading at $79.80. I remember the figure exactly the same. So oil prices doubled from in a year's time. So I think we are heading to the same era. We might see oil prices moving to 120 to $140 per barrel in the second quarter or maybe in the first quarter of 2022. And then oil prices will stabilize and they will eventually come down as we will see more supplies coming to the market. Right now, the production cuts are intact. Saudi Arabia and uh, Russia are calling the shots. And I am very fortunate that I have been following the book of a Canadian. His name is Merin Katusa, and
Mm-hmm.
he wrote this book in 2014. If you see
Okay.
this book, The
Yeah.
Colder War,
Mm-hmm.
how Russia emerged the winner in terms of energy outlook. And Merin Katusa is one of the smartest hedge fund managers based in Canada, based in Toronto, and he made the right call. So there's a chapter in this book called Putinization of Oil. And as you know, very few people actually know that Putin is a PhD in economics. On page 87, he talks about how Putin in his thesis, PhD thesis that he did in 1997, that how he is going to change Russia by using natural resources. As you know, 50% of oil and gas in Europe comes from Russia through Ukraine. And Ukraine is a very key point for many European countries. So whether we talk about Germany, France, UK, Holland, Finland, Belgium, everybody gets their oil and gas from Russia. And if you see the last week issue of Economist magazine, Yusuf,
Mm-hmm.
it says the energy shock. And in the articles, it talks about that we have not seen enough capex investment from oil and gas companies in the last 2 years, and suddenly the economies are opening up post COVID, and the demand has upsurged. So supply has not kept up pace with the demand, and demand curve is very strong right now. So we see oil prices to be on the upside. I don't see oil prices taking a backseat in the next 2 to 3 months. So oil is hot, and economies like Canada, Russia, US, Qatar, Saudi Arabia, all those oil exporting countries, they will tend to benefit from the rising oil prices, and commodities are on the bullish mode. So once you have commodities on the bullish mode, many economies will upsurge, and those economies who are importing, like Pakistan, Bangladesh,
Yeah.
they will have a slow growth mode in the next 2 to 3 quarters.
Wow, amazing. I mean, you still remember the exact, the amount what was quoted in 2008, and as I can see that, oil prices will continue to rise, and we will expect them to continue to grow and go up, and then we could expect it. But as you rightly said, from Canada perspective, it would be something, they would benefit on that, especially for the people who are talking, who are listening about the Calgary market, the Alberta market. We just did a project last week. We were talking about a project in Calgary, and we were just, I'm just trying to relate that to the real estate thing. That where we were saying that the Calgary prices have started going up, and I mean, oil is one of the major factors which goes along with that as well on that. So
Yes, yes.
yeah. So next to my second question, and of course, I want to share this slide to our viewers so that they're also looking at to my next question. So, Sean, you have been saying that bond is the worst asset class to be in now, and you're again spot on. The reason, please share the premise to our valued investors. Moreover, the Bank of America has released the bond market outlook with a lot of investors offloaded their positions in the bond market. And what's the number of global sovereign bond in negative?
Yes, Yusuf, you and I, we have been talking for quite some time now. And Warren Buffett shared last year and this year as well that bond is the worst asset class to be in. The reason is very simple. Your inflation is up 5%, and your 10-year treasury yields are trading at 1.58, 1.6. So your income is 1.6, and your cost of living is 5.3, 5.4. It doesn't make sense. So your cost is higher than your income. So you're already in negative. So you can't stay in the bond market for very long. And when yields are rising, it's an indication that you have higher inflation coming into the market. That's why the yields are going, and the investors, they want more income for their investment. As you rightly pointed out, that Bank of America in the recent report has mentioned that a lot of institutional investors, when institutional investors are offloading their position, it's an indication that one market is heading for shenanigan. It is heading for bloodbath. It is heading for bedlam, and investors are not confident about the outlook of the bond market, the fixed income market. I'm always excited about the debt market, But the problem of debt market is that inflation is coming back, and it is coming back with vengeance. So this is not the time to take position in the bond market. So a lot of institutional investors, you have shared the graph that your viewers and your valued investors in Canada can have a look. Institutional investors offloading the position, it's a clear signal that this is not the time to stay in this asset class. A lot of institutional investors are moving into equities. Uh, Pension funds are also offloading. Endowment funds are offloading their position in endowment, and this is a bad signal for the market. And plus, US dollar staying very volatile, so it's a double-edged sword for many investors. That's why we have seen in the last 6 months, investors are not very confident about the bond market. And in the foreseeable future, I see more and more institutional investors, they will be offloading their position as inflation will go up. And once inflation stays at that level and the central banks they raise interest rate, that will be more volatility and pandemonium in the market. So bond is not the best asset class. I think most of those investors who understand history and economics, they are looking at stagflation. 1970 era is back after 51 years. I think real estate and commodities will be back in action, and they will remain on the global investors' radar for the next 2 to 3 years.
As you always say that, it's always something which you can hold on to, something yourself, which is the real estate and the commodities in terms of the gold and silver is definitely a good asset class to look at. So people who are joined right now to us, we are live with Shan Saeed, our chief economist, for Juwai IQI. If you guys have any questions or comments, please feel free to put it into the comment box. There is a contact information going on, which you can contact us for any questions you guys have. And of course, knowing Shan, I know that with his insights, valuable insights, he can always get back to us on that. So Shan, that brings me to my third question. And before I do that, let's look at this particular graph, which is called the tech bubble, top five US cap stocks in 2021. So tech companies are under a lot of scrutiny. Do you think concentration of these companies like Facebook, Instagram is getting precarious? More taxes and penalties on tech giants. What's your opinion on the tech industry outlook? Google was fined $177 million in South Korea. What's going on, Shan?
Yes, Yusuf, a lot of these technology companies are under scrutiny, as you rightly pointed out, and a lot of regulators from across the globe, they are having a very close eye on these uh, tech companies, whether it's Instagram, whether it's Google, whether it's Facebook. A lot of data is coming out, data is being leaked. So, investors are getting nervous, and regulators are finally getting after them. And I think this process will continue. And as you rightly pointed out, South Korea has fined Google. Facebook has been asked to leave the China market. LinkedIn has been asked to leave the China market. So I think with technology companies, they need to change their model to be more transparent, to be more open with regulators. And regulators, I think they have made timely move. I give them full credit for coming down very hard on these technology companies for not being very open and transparent. And with this, I think more and more investors will continue to demand transparency. So, openness, transparency, these are the buzzwords that are coming back into the market. So, once the regulators, they will come to know that investors are demanding transparency. So I think more technology companies will change their role, will change their business model. So I think I see more and more technology companies will be having an engagement strategy with these regulators, and they will find out a way how to be more transparent so that all the stakeholders will tend to benefit. And the data, the most important thing, I still remember in 2017, 7th May 2017, Economist magazine had a cover story, data is the new oil. So data
Yeah.
has become very, very important, not only for us, but also for many companies globally. So privacy of data, having confidentiality of your investors' information is very important, because investors, they have got huge trust in your abilities and in your firm, and they want data protection. So I think these technology companies will remain under the radar, and their market cap, which is quite big, of these technology companies. Look at Apple, look at Google, look at Microsoft, $2 trillion of market cap, which is more than the size of GDP of Spain, Russia, or even Canada or South Korea. But these technology companies are becoming giant. And with more concentration, they are consolidating, and the markets are feeling nervous. And the regulators, they finally, they want transparency from these technology companies. So I think with more transparency coming into the market, I think the technology companies will be in line with market forces, and they will follow what the regulators are saying to them. So I think more regulations will be coming for technology companies, and technology companies, they have to comply by those regulations.
Awesome, awesome, awesome. Very well on that. So before I go to my another question to you, which is definitely your favorite topic, which is inflation, discount rate, and currency market. How do you foresee the market as Fed tapering bonds and Bank of England has given indication that high inflation will push the central bank to raising rates? Chief economist of BOE he said last week, it was reported in Financial Times, and I like to quote that Bank of England's new chief economist, Hopewell, said inflation in Britain could surpass a very uncomfortable 5%, and the question of whether to raise interest rates was was live, one of its early November meeting. Phil told newspapers in the interview published on Thursday that decision facing the Monetary Policy Committee was finally balanced and added. I think November is live. So I would not be shocked, let's put it that way, if we see inflation been close to or above 5% in the months ahead, and that's a very uncomfortable place for a central bank with an inflation target of 2% to be unquote. So do you think Bank of Canada will follow the same path in the next 12 to 18 months? Kindly enlighten us with your global market thoughts on this.
Yusuf, very important question. As I speak to you, inflation globally is very, very high. In US is 5.4, as you mentioned. In UK is above 5%. In Europe is 3.5%. In many economies, inflation is getting serious. And you'll be surprised to know, since April, I have been sharing in Malaysia what Janet Yellen have been saying is not in line with market forces. And she is wrong. She was saying that this inflation in US or in other parts of the world is transitory, is temporary, and it will die down very soon. But I went on the other side, being a contrarian economist. I went on the other side of the table and I said, no, this inflation is serious, and this inflation will stay ahead. And if you recall, we shared in our last 2 months in our session that we mentioned about in a newsletter in November 2020. Who made the first call? Juwai IQI, stagflation is going to hit advanced economies.
That's right.
And
Yeah.
right now, when I speak, stagflation is already hitting advanced economies. What is stagflation? I repeat, when you have high inflation, when you have low growth, and you have high unemployment. COVID has put 100 to 300 million people out of poverty, into poverty. And 20 million people, they have lost their jobs globally. And if you see the recent survey of McKinsey, in the next 4 to 6 months, many millennials will lose their jobs, and they will be quitting their job without having one. So this is a dangerous scenario, taking into account that people are quitting their jobs and they don't want to come back into the job market. So with inflation high, your income levels are not going up, your salary is not going up by 5% or 10%, but your inflation is up. I give you a very small example, because my sister, she lives in UK. Very small example. Tesco. The
Yeah.
price of cornflakes have gone from 50 pence to 55 pence. Straight
Yep.
10% increase.
Yep.
But your salary has not gone up by 10%. So it
Absolutely.
looks very small, but the rise is very serious. So this inflation will stay. We have already mentioned stagflation will hit many economies because global central banks have printed a lot of money.
Yeah.
The four big central banks, Fed, ECB, European Central Bank, Bank of Japan, and Bank of England, these are the four central banks. The total balance sheet of these central banks is more than $27 trillion. So imagine they have printed money like 24/7. So
Yeah.
from 2008 onwards. So for the last 13 years, they have been printing money. So printing money, coming to the market, inflating the price of equity and bond market. This is going to create havoc. So inflation is serious, and we have always shared with our valued viewers who are watching that in 1970s, smart and sophisticated investors they only took position in two asset classes: real estate and commodities, gold and
Yeah.
silver.
Yeah.
So these tangible assets can give you protection. They can give you peace of mind. So with higher inflation coming into the economy, your value, the wealth that you want to preserve, the wealth that you want to protect, the wealth you want to increase can only be increased when you take position in these tangible assets, in these real assets. Last month, 17 September, economists issue they mention how stagflation is going to protect your investment if you invest in tangible assets. They mention about properties, commodities, and farmland. A lot of
Mm-hmm.
people and sophisticated investors they are going into agriculture. Why agriculture? You love rice, you love coffee, you love wheat, so do I. Everybody wants to consume this,
Yeah.
and the demand is very much there, but the supplies are not coming into the market as fast as the demand. So I think these sophisticated smart investors, especially from advanced economies, they send the signal to other markets, especially to emerging markets. So real estate will continue to thrive because everybody needs a house. And if you want protection, gold and silver, these tangible assets, they will provide protection to your hard earned investment. And when you are devising your asset portfolio, you have to think long term that how I am going to position myself in the next 2 to 3 years. How am I going to protect my investment for my children or for my future generation in the next 2 to 3 years? So investment is getting very volatile. You have to be very savvy. You have to be very sagacious, and you have to understand the market's outlook. And in order to understand the market outlook, you have to get solid market intelligence reconnaissance. What is happening? And you have to stay ahead of at least the mainstream media by 2 to 3 quarters. And at Juwai IQI, we are try our best to keep our investors at least 2 to 3 quarters ahead of the mainstream media. So by the time mainstream media is talking about a certain thing, we have already shared with our investors. So now you pick up Wall Street Journal, Financial Times, New York Times, Washington Post, Baltimore Sun, Boston Globe, Los Angeles Times, The Guardian, The Times of London, the Le Monde in France. Everybody is talking about one thing: stagflation. So
Yeah.
when we were talking about stagflation, nobody was even covering about it. Why? Because our global networking, people who are smarter than me. And I still remember I was in class one, 1980, 1981. My mother said, you have to be with people who are smarter than you. So you have to stay connected with those people who are smarter. So as I say, the person is known by the company he keeps. So we are fortunate that we keep company with smart people who give us on the ground, boots on the ground information, and they keep us ahead of the mainstream media. So I think inflation is serious. Interest rates will go up in the next 12 to 15 months. If these big four central banks, they will raise interest rates, I think other banks will follow as well. I think Bank of Canada will also raise interest rates by 25 to 50 basis points in line what Fed does, because Fed is your neighbor, and
Yeah.
whatever Fed does, it will have impact on Canada as well. So I think this is a good time for those real estate investors who are following Juwai IQI, who are following Yousaf Iqbal's and his team's insight in the market. And Yousaf has been very, very relevant. He has been sharing those market intelligence report not only for Toronto but also for Cambridge, Calgary, Alberta, Edmonton, Mississauga, and many other places in Canada. And he has been spot on. And many investors who are following Yousaf, they've actually benefited from his insight. So, my message to all the investors in Canada or those potential investors in other parts of the world that they should reach out to Yousaf Iqbal and his team, and they will give you the solid market intelligence report because they have team who is on the ground and they know each and everything about real estate in Canada so that they can benefit, they can leverage from these people, from his team, so that they stay ahead of the market.
Thank you very much, Sean, for that. I mean, thank you so much for your kind words. But yes, as you rightly said at Juwai IQI, we are always ahead in two, 3 quarters than the mainstream media on that. And definitely, that goes along with the full teamwork. And, that's the reason we say that why Juwai IQI is so different as compared to anybody else is that because, as you rightly said, it's all about the market intelligence, the market data, the networking. And of course, we have Shan Saeed, who gives us all the market intelligence report ahead of us, which actually, helps us as as country heads, to use that information along with your investors and guide them at the same time. Shan, always an awesome session from your side. Thank you so much. Anything else you want to say before we say bye to our audience?
Thank you, Yusuf. Thank you to you and to your team for always having me. It gives me great pleasure, and I love to share this market intelligence report so that the greatest obsession of my life. I'm turning 48 next month. That how investors can leverage from us, how they stay ahead of the market. That is our obsession. That's why we have this newsletter, and the newsletter is a pure testament of Juwai IQI that we want to have an engagement strategy. We want our investors to leverage from our networking, and we want our investors to go through our newsletters so that they know what is happening in the global macro outlook and what is happening in the financial markets so that they can protect their wealth, they can preserve their wealth, and they stay ahead of the market.
Excellent. And thank you so much for pointing out the newsletter part. If anybody's interested in Juwai IQ newsletter, which is done every month, we got Shan Saeed, we call him, plus all the different countries of what's happening around the real estate. Do contact us, on your comment box, just put in your contact information and ask for the newsletter. We'll send you that on that. So thank you very much, everyone. Please take care of yourself. Thank you, Shan, again. I wish you happy birthday to you in advance, and you have a
Thank you.
wonderful day today. Enjoy yourself, and so thank you so much for all your insights. Take care, everybody. Bye bye.